Hello people, this is Sandesh. Hope you're all doing good. So great news, the exam has ended. I'm sure the mighty pressure on your head is lifted now and all of you are having a big smile on your faces, at least for the fact that the examination is over and for all that efforts and sleepless nights that you've undergone. Yeah, you can put a break to all of that. Yes. So in today's session, we'll be quickly reviewing FM Jan 2025 paper ka, like how the paper was, etc., etc. All right. So yes. So if you ask me how was the paper, I would say pretty straightforward, sir. A pretty easy paper, I would say. Yeah, maybe some questions you can look at it as it could be lengthy, right? You may lose track of time and take a little extra time. But in terms of the concepts, what they tested and the questions that they asked, I would put the overall paper into easy or pretty average category only. Quite a scoring topic, okay? The last few attempts may FM, they used to do a little bit of here and there, some extra questions they used to hold up and some new adjustments they used to bring in. But this time around, mostly all the questions are around the same concept. Nothing newly was introduced in my view, okay? So apologies, I couldn't do this review today. I was held up with CA final financial reporting classes, so I'm getting the time now, so we're publishing it today. So, but either ways, I'm mighty proud of you all that you have stuck through. You have not given up in between. You have written all your examination. You have given your best. Doesn't matter what the result is. Still very, very, very proud of you because effort in my books is what really matters. And I believe all of you have given your best possible. Okay, so don't worry too much about evaluation. Okay, I know that you have a lot of review videos now. You can go on comparing and do it. But trust me, people, our valuation and invigilator, the actual valuation of ICMA, there will be certain differences. So don't freak out or don't keep calculating and think that I'll only get 20 or I'll get 60 or whatever. It's okay. You have done your part now. Okay. Invigilation is the part of ICA. So let them do their job. So they will do it and they'll let you know after 1 month. Then you can do that balle balle dance that I've passed or whatever it is. Yes. So for now, chill, take a break. Okay, take some time off and travel, have fun, hang out with your friends, okay, go on some tours, okay, whatever is your hobby other than studies, obviously, pursue them now. It's a time to do that, right? So don't freak out. So having said that, so today's session, let's quickly review the MCQ questions of first with FM paper. First, so case scenario 1, VP Limited provides the following information. So they've given some current ratio, not in the value, 1.5 basically. Sales, they're saying is totally 150 lakh. That 80% of it constitutes credit sale. So 80% of 150 lakh will be 120 lakh. So balance 30 lakh or 20% of 150 lakh, which is 30 lakh constitutes cash sales. Inventory turnover ratio is given, collection period is given, GP is given, quick ratio is given. The requirement, current assets and current liability, you need to find out. For this, each component we need to find out. First, credit sales, do you know? Yes. We'll start with working note number 1 to find out the debtors. So total credit sale was given to be 150 lakh. Credit sale was 80%. So if you calculate, you'll get 120 lakhs. So that's your credit sales. And they told collection period is 12 months. That means this 120 lakhs is a sale for 12 months. But we don't give 12 months credit to our debtors. We gave only 2 months credit. So for 2 months, what is a prorated sale? 120 lakh is a sale for 12 months. For 2 months, how much it will be? 20 lakh. Like this straightforward way you can do. Or you can also find out debtors turnover ratio and calculate debtors from that. Your choice. I believe in this. It is faster. Okay, this is one. Debtors we got it as 20 lakh. Then, now inventory turnover ratio is given. Using that, I think we can find out inventory. Inventory turnover ratio is COGS divided by inventory. For that, first we need to know COGS. Sales is 150 lakh. They told GP percentage is 20%. So COGS will be 80%. So which will be 120 lakh. So substitute this in inventory turnover ratio formula to get the answer. Inventory turnover ratio is equal to COGS by inventory. ITR as an inventory turnover ratio is given to be 6. COGS, just now we found out 120 lakh. Divided by inventory, if you do, you'll get the answer to be 20 lakhs. Fine. That's what was the next question also. How much was inventory and debtors they asked? Both are same, 20 lakh. B for Bengaluru is the right option here. Okay, next they asked current assets and current liability. For that, substitute. They gave you current ratio is 1.5:1, or rather it's saying current ratio is 1.5. Substitute. How do you get current ratio? Current assets divided by current liability. So therefore, current assets is equal to 1.5 times of current liability. Keep this in mind. As I told you, usually in these sort of things, they'll also give you current ratio and quick ratio to do as the substitute. They've also given a quick ratio 1:1. So quick ratio is basically 1. How do you get quick ratio? Quick assets divided by current liability. That's one way to do it. How do you get quick assets? Current assets minus stock. This was a formula that we have used in multiple questions in our classes. Okay, I told you, in fact, written this as a pointer also. Whenever these comes, do the substitution. So current assets minus stock, if you do, you'll get quick assets divided by current liability. Current assets we don't know, but stock we just now found out as an inventory is 20 lakh. So substitute. So current assets minus 20 lakh divided by current liability is equal to 1. Then current assets minus 20 lakh is equal to current liability. Like this you'll get. But you already know current assets from the previous equation is 1.5 times of current liability. Substitute. Instead of current assets, write 1.5 times of current liability. And this is 20 lakh. This is current liability as it is. Solve this equation. You'll get current liability to be 40 lakh. If current liability is 40 lakh, current asset is 1.5 times of that. So it will be 60 lakh. So answer is current asset is 60, current liability is 40. Current asset is 60 and current liability is 40. So C for Chennai is the right option for a right answer for that particular question. Okay. Pretty straightforward. 4 marks, swaha. All right. Next, 1 markers ka some MCQ they had given. So let's review that. JK company has a current assets of 1 crore, current liability of 50 lakhs. Current assets minus current liability will give you working capital of 1 crore minus 50 lakh. If you do, you'll get 50 lakh rupees. The finance manager of the company wants to make provision for contingency 20% of working capital. Accordingly, what will be the working capital? This we used to call it as what, sir? Safety margin or provision for contingency. Working capital is 50 lakh. To that you add safety margin. Safety margin or contingency is 20%. 20% of 50 lakh is 10 lakh. So the net working capital will be 60 lakh rupees. So A for Ahmedabad or Alpha is the right answer for that particular question. Okay, again, 5 marks straight away, swaha, not much time also it will take. Yeah, this particular case study, yes, it might take some time. They are given a pretty lengthy stuff. Calculation, I think some of you would have calculated this and got wrong answer or anything, especially in the indifference point and all, but it's okay. I mean, if you properly calculate it, okay, you would have got the answer straight away. Okay, anyways, let's quickly review. Company is there, it's operating in that business, this business goal they have given. We don't have time for all that story. We'll directly dive in. Existing capital of Coral Limited is as follows. They have 10 lakh shares of 10 each. So existing share capital 1 crore. 15% debentures is already there. 30,000 debentures of 100 each. So 30 lakh is the existing debentures. So totally 1.5 crores is the capital employed currently. Now this company, they want to expand. All right. Obviously for expansion, they need new funds or additional funds. Additionally, they need 100 lakh more funds. Okay, expected EBIT and taxes after this additional investment is 76 lakh. So when you take an additional investment, you obviously will use it for your expansion or new project purpose. That will generate extra EBIT for you. So they are saying after this project, expected EBIT after additional investment. So total EBIT after this additional investment is expected to be 76 lakh. This is given. Tax rate is 30%. Great. They are asking what's it? 2 alternative source of fund is there. We want to raise 100 lakh. There are 2 ways to raise this money. Plan 1, plan 2. In plan 1, it's 30% equity, 70% debt. So 100 lakh or 30%, as in 30 lakh will come through new equity shares. 70%, that is 70 lakh will come through debt. So if you are issuing new equity shares, they're saying the face value of the equity shares is 10 only, but it will be issued at a premium of 15. So the issue price will be, you're issuing it at 15 rupees premium. So don't take issue price 15 rupees. 10 rupees face value issued at a premium of 15 means issue price is 25. Okay, that is one common mistake some students would have done. So issue price should be taken as 25. All right, fine. This is one. Then in the plan number 2, 10% of the money will come through equity, that is 10 lakh. 100 lakh or 10% is 10 lakh will come through equity. 50% will come through debentures, that is 50 lakh. 40% will come through preference shares. So first is equity and debt plan. Second one is equity, debt and preference shares plan. So pretty much straightforward. Yes. You are required to answer 4 questions from this particular, 4 or 5 questions from this case. What is the indifference point between plan 1 and plan 2 is what they're asking. So the indifference point means what? Indifference point means that point at which obviously your EPS will be 0. Yes. Now what should be your EBIT? Basically that will lead to EPS becoming 0. For this we have simple formula. No? How do you get indifference point? Basically EPS ka formula, we have to structure it in a English, I mean, in a different way. Okay. So that is what indifference point is EBIT minus I1 into 1 minus tax rate minus preference dividend divided by E1. Here I1 stands for interest under plan number 1. Okay. EBIT is anyway EBIT. E1 is number of equity shares under plan 1. So this you'll have to substitute with the other plan because at the indifference point both the plans will give same EPS. Okay, so EPS with plan 1, EPS and plan 2 ka formula you need to equate. Okay, so now before doing this question, it's always good to have some data. All right, so let's put this on hold. They've asked multiple questions, so if you just check, Let's solve the next question. That will give us a lot of data to proceed with this. Like here, this. They are asking what is the current EPS under plan 1 and plan 2. If you solve this first, no, some basic data will always be there. Using that, it's easy to calculate indifference point. So under the current plan 1 and plan 2, you have raised the fund. No, they are asking earnings per share. So how do you calculate earnings per share? The answer to question number 6. So EPS you need to calculate, sir. EBIT is already given in the question. How much is EBIT? After you expand, EBIT will be 76 lakh. From EBIT, how do you get to calculate what, sir? EPS, what do we need? Meaning earnings attributable to equity shareholders, which we in our class purpose used to call it as ESH, or also known as net income, divided by number of equity shares. We need ESH, but they have given EBIT in the problem. So what do? Reduce all the things. First, interest. All right, but do not forget we have issued some new debentures. All right, and then existing debentures are also there. Come back to the question. Under plan 1, how much new debentures did you issue? 70 lakh. They carry what interest rate? 13%. So 17 lakh at 30% if you do, you will get 9.5 lakh. That is the interest of new debentures under plan 1. Okay. Similarly, what was the existing debentures? Company already has 30 lakh of debentures which carries an interest rate of 15%. So 30 lakh of 15% if you do, it's 4.5 lakh. This is the existing, or this is the interest under plan 1. Similarly, find out the interest under plan 2. Existing interest will be same, 4.5 lakh. Okay. In plan 2, how much debt are you raising? You're raising a debt of 50 lakh and interest rate is 13%. So 50 lakh or 13% if you calculate, 6.5 lakh. These are the two interest under the respective plan you'll get. From EBIT, if you reduce both the interest, you'll get earnings before tax. Tax rate is 30%, so reduce it, you'll get earnings after tax. Then we need ESH. So if there is any preference shares, you'll obviously have preference dividend, so reduce that. Plan 1 does not have any preference shares, so leave it. Under plan 2, 40 lakh of money is coming through new preference shares. Existing preference shares is anyway not there. Existing, my company had only equity and debt. Okay. Under plan 2, new preference shares came for 40 lakh and these preference shares carry a dividend rate of 7.15%. So 40 lakh or 7.5% if you do, you'll get preference dividend. So deducting all this, you'll get ESH. The only number next you need is number of equity shares. So you have some existing equity share capital already and you're issuing some new equity shares. So we need to calculate separately. Existing, how many equity shares company already has given? 10 lakh. So it doesn't matter which plan you go for, existing shares will remain same. New shares you need to find out. Under plan 1, how much money will come through equity shares? 30 lakh. And you are issuing each equity share at what value? 25. So 30 lakh divided by 25 if you do, you'll get 1,20,000 shares. So existing 10 plus 1,20,000 new will make it total number of new equity shares to be 11,20,000. Okay. All right, next. Under plan number 2, how much money came through equity share capital? 10 lakh. How much price you are issuing one equity share for? 25. So 10 lakh divided by 25 if you do, you'll get 40,000 shares. So adding these two, you'll get total number of equity shares to be 1040. So you know each, you know number of equity shares. So divide these two. Each divided by number of equity shares. 43,68,000 divided by 11,20,000 if you do, you'll get 3.9 and 4.1 respectively. Okay, so the answer is 3.9 and 4.1. C for Chennai. Okay. Next, they ask MPS. They have given you PE ratio. So how do you get MPS? All right. MPS is nothing but EPS multiplied by PE multiple, right? That they have given. Okay. In fact, you used to remember like this. PE ratio is equal to MPS divided by EPS. That's how we used to solve. Price earning ratio. Price here stands for MPS. Here stands for EPS. So therefore, what will be, sir? MPS is equal to EPS multiplied by PE multiple. EPS we have already found out. Okay, PE multiple they only given in the question. For plan 1 it is 12 and here it is 15. So these two you multiply, you will get the market price of the share as 46.8 and 61.5. That option is there in Bengaluru. Okay, all right, this is about question 6 and 7 answer. Fine, we'll do of this first and then we'll go back to the previous question. Then they're asking what is financial break-even point. Okay, financial break-even point. Oh, you already know financial break-even point means what should be your or it's a point at which your EPS should become 0. All right, we already studied. If you have only equity plan, financial break-even point is if your EPS has to become 0 means EBIT also has to be 0. Right? What should be your EBIT so that your EPS should become 0? That we call it as financial break-even point. If you have only debt plan, then EBIT should be equal to interest charges. If you have only preference share plan, then EBIT should be equal to preference dividend divided by 1 minus tax rate. All this we proved it with numbers in our regular class, right? But if you have all the 3 plans, then add everything. Okay, equity ka you ignore. So if you have all the equity and if you have debentures and preference shares, financial break-even point is given by the formula interest plus preference dividend divided by 1 minus tax rate. That's what you'll have to do over here. All right, interest you already know. That's the reason it's good to solve this first. You have all the basic data. So these two if you add, you'll get the total interest in plan number 1. These two if you add, you'll get 13 lakh 60,000. That's what I've taken here. Okay, this is the interest. In plan 1 menu, sir, we are raising only what? Equity and debt. Preference shares is not there. So if preference shares is not there, then interest charges itself will be your financial break-even point. Total interest charges is how much? 13,60,000. Preference dividend anyway is 0. So financial break-even point is 13,60,000 only and plan 1. Okay. Under plan 2, how much interest you had? These two, if you add up, the total interest will be these two ka interest 6,50,000, 4,10,000. So you will get 11 lakh rather. Yes. Total interest is 11 lakh. But under second plan, you also have preference shares. Whenever preference shares is there, you need to consider preference dividend divided by 1 minus tax rate. Do you know preference dividend? Yes. 2,86,000. Here preference shares is not there. So preference dividend is also 0. Under plan 1, preference dividend is 2,86,000 divided by 1 minus tax rate you do. Tax rate is 30%. You will get 408,571. These two, if you add, you will get financial break-even point. Whenever you have debt and preference shares, financial break-even point is given by the formula interest charges plus preference dividend divided by 1 minus tax rate. So hence these two you add, you will get 15,08,571.42. Here these two if you add, you will get 13,60,000. That is the answer. Which option has that? 13.6 and 15.08. 13.6 and 15.08. D for Delhi is the right option for that particular answer. This is your 6, 7, 8 ka question. Okay. Now coming back to this indifference point, I'm sure pretty many students would have wasted time on this. So if you had started with this, no, you will not know the interest. So then you will have to keep calculating and all. So hence it's always good to read. That's the reason we say whenever they give you case-based question, first read the questions first, then read the case so that you'll know which order to answer the question. Now to calculate your indifference point, okay, indifference point means what should be your EBIT so that two plans will give you same EPS. Okay, two plan ka EPS you need to equate, and that EPS is given by this formula, right? So interest and all, now I don't have to calculate because I already know under plan 1 interest is 1360, plan 2 the interest is 11 lakh. If this data is available, that makes me to solve this question faster. EBIT we need to find out. So put it as indifference point means what should be the EBIT so that two plans will give same EPS, right? So we don't know the EBIT, we have to solve and get EBIT here. So EBIT minus interest under the first plan interest is 13,60,000. I've substituted into 1 minus tax rate. Under first plan, preference dividend is not there, so 0. Divided by number of equity shares. That also I've calculated. Under plan 1, total number of equity shares is 11,20,000. So taken that. Okay, fine. So this is first part of the equation. Then similarly, EBIT is question mark minus interest under plan 2. Under second plan, the interest total interest is 11 lakh rupees. So minus 11 lakh into 1 minus tax rate minus preference dividend. What is preference dividend under second plan? 2,86,000 divided by number of equity shares. What is the total number of equity shares under second plan? 10,40,000. So solve this. If you solve this equation, finally you will get EBIT. I've solved it fully just to make sure that you know that we're not just taking like that. When you solve, you'll get EBIT to be 34,40,000. So which option has 34,40,000? A for alpha is the right option for question number 4. Okay, time consuming but easy only. Okay, if you started with this question now, then you'll be stuck because you'll not know interest. You'll have to calculate in haphazard way, write it and all. But if you had started with this particular question, all this you would have already calculated. So it's easy to substitute. Okay, so that's the reason it's always not just important to know the question. It is also important to know the order of answering this question. Okay, that also plays an important role because all this question you have to answer, not just answer within that time. Okay, so then what should be the EPS? Sorry, they already asked. 1 second, hang on. What should be the EPS in plan 1, plan 2 for indifference point calculated above? You calculated indifference point. Sir, EBIT they gave in the question is 76 lakh. At 76 lakh, what is EPS? We have already calculated. 76 lakh is not indifference point ka EBIT. Alright. They are saying what is the EPS for indifference point? At indifference point, EBIT is 34,40,000. Alright. If EBIT is 34,40,000, what will be your EPS? And we know that at indifference point, both the options will give same EPS, right? So first option has 1.65 and 1.75. This can't be the answer, okay? Because both the plan ka EPS should be same. That's what indifference point means. So this two, 1.65 and 1.75, 1.8, 1.9, they are different, so you cannot answer. The answer will be either 1.3 or 1.5. Okay, that way also you can conclude. Or anyway, you know EBIT. EBIT now is 34,40,000. Substitute EBIT 34,40,000 in this and get the answer. That's also. Or you can present. 1 second. 1 minute. Okay. You can calculate from the beginning like this. From EBIT, you can reduce all the interest and then calculate EPS like that. That is one way. Or anyway, you know indifference point ka formula. No? Okay. How do you get EPS? EBIT minus I1 into 1 minus tax rate minus preference dividend divided by number of equity shares in plan 1. Now you know anyway EBIT, substitute that and get the answer. That's all. Okay, substitute EBIT 30 4 lakh 40,000. That's what I've done over here. Okay, this is a formula to get EPS. Okay, you can do it in normal way also. Indifference point ka formula also you can use. Now you got at indifference point EBIT is 34 lakh 40,000. Do that. Under plan 1 interest is 13 lakh 60,000. We already have it here. Under plan 1 interest is 13 lakh 60,000. Okay, minus into 1 minus tax rate minus preference dividend. Preference dividend is not there in plan 1. Number of equity shares in plan 1 we already have, which is 11 lakh 20,000. Substitute, you will get 1.3. Obviously, one if you solve, answer is good. Other one you don't have to even solve, because indifference point means both of them should have same EPS. Even if you solve this also, here EBIT is 34 lakh 40,000, interest is 11 lakh, minus preference dividend is also there, 2 lakh 86,000. Number of equity shares is also there from previous working note. You will still get what? 1.3. That means the right answer here is 1.3 B for Bengaluru. Okay, if you just check overall, maybe other than 1 or 2 questions here, I still feel if you had done this little more vigilantly in proper order, you would have still got this within the time and you would have got the correct answer. Okay, fine, sir. This was about MCQ question. All right, so overall, all the MCQs, in my opinion, are pretty straightforward. Even the other descriptive questions, the way I see it, most of the questions are concept is nothing, no new concept is created. Ditto, 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 they have put it up. Okay, here if you just check the budgeting wala problem, we have done such questions in our class, right? Okay, similarly here they've asked your leverage wala question, pretty straightforward. Yes, then what, sir? Walters and Gordon's model and all they're asking. Again, pretty straightforward, plugging the numbers into the formula and getting it. Okay, all right. This is about what your conversion mean. Remember they've asked WACC CCM method. This is also pretty much manageable, or here you may get it stuck a little bit in some areas, but overall still if you read the question properly, still you should be able to get it. Number of operating cycles, pretty straightforward, study material or class material question, same. Okay, all right. Then what, sir? Even this is also, right? Maybe a new question, but anyway, no new concept. Same data they have taken and they've changed the name and value and put it up as question. NPV, profitability index. Again, all these are pure substitution questions. The way I see it, nothing new in this particular FM paper to really break our head. Yes, 1 or 2 MCQ questions may be lengthy, and some calculation of NP and all may take a little time. Lengthy wise, I might give it to you. Sometimes you may lose track of time, but overall, pretty straightforward paper. So hope the paper went well for you. Okay, so wish you all the very best for your results. Take care. Okay, God bless you. Bye bye.